this is the first in our crypto fund series. A little bit about our firm. We were founded in 2010, sorry, by John Lohr, and we focus exclusively on advice to emerging and established private investment funds throughout the United States and also throughout the world. Our attorneys are constantly looking at investment fund issues. We author white papers, blogs, ebooks, a lot of which is available on our website. And because we are so focused on the private fund space, we are in touch with a lot of asset managers, and it enables us to keep up with a lot of emerging industry trends. Of the cryptocurrency funds that exist in the world, and there are around 200, we have assisted asset managers in bringing to life about over 10% of them. So we do have a fair amount of experience in this space. So what I am going to do is give you an overview of the types of the laws that bring us to the private fund space. And our co-speakers will elaborate on some of those areas. And that will give you a sense of how we're able to focus specifically on our client base. So first, to give you a little bit of my background, I started at the Securities and Exchange Commission in the Office of the General Counsel, where I had an opportunity to litigate cutting-edge issues, either representing the commission itself or as amicus in very, very interesting cases. So looking very closely at the question of what is the security, it's not always common sense or intuitive, but and the position that the commission takes with respect to a whole host of issues, disclosure-based and everything else. After I was in the Office of the General Counsel, I was in the Division of Corporate Finance for a while. And then after having plied the hallowed halls of the SEC, I decided I wanted to learn a little bit more about the legislative process, and I actually became a registered lobbyist in DC for a little while and learned about how the process really works, which was an eye-opener.
How the sausage gets made.
So after that, I started to focus in the fund space, and I actually went to work in a mutual fund company, so in the public fund space. And I went with a fund a multi-billion-dollar investment fund that specialized in socially responsible and high-impact investing. After doing that for a fair amount of time, I went into private practice, both with AmLaw 100 firms and with small firms, and I found my way to Capital Fund Law Group, which is a boutique firm specializing in this very, very interesting area. So that's how I got here. And what we're going to do today is, first I'd like to explain to you the overall structure of the type of fund that a cryptocurrency fund is. So the presumption in the securities laws is that everything has to be registered. So we started in 1933 with the Securities Act of 1933, and that deals with registrations. And that provides the definitions of securities, which isn't always intuitive. So for example, you have shares of publicly traded funds. Well, we all know that those are securities. You have companies that decide that they need to raise capital, whether it's equity or debt, and you have fractionalized shares, and you have securities, you have to register them, and you get to sell them to the public. But then you have things that the Securities and Exchange Commission has decided are investment contracts. So you have orange groves, for example, and you want to make money from the orange groves. So you enlist someone to manage the project, you have fractionalized shares, you sell them to the public, and lo and behold, those are securities also. And that's one of the interesting emerging areas of the law right now when you come to cryptocurrencies. So that's an outstanding question right now, whether the currencies themselves or the shares in the currencies are securities. And we seem to be heading in the direction where the commission is probably going to take the position that it is, but whether it is or not, you'll see a lot of people now acting as if they are, so that the disclosures in their disclosure documents when they're selling to investors is sufficient to pass muster, just in case it comes to the point that day when they say, yes, definitively, those are securities. So then you have the Securities and Exchange Act of 1934. That's the act that created the SEC. And that is also the act that governs the secondary shares, secondary market and shares of securities. It governs the exchanges and governs the conduct of broker-dealers and related sales. So again, the presumption is that everything that is a security under the Securities Act has to be registered. However, the reason is that you can sell those securities to anyone. And public policy has dictated that when you are selling to the public, you need to make sure that there's full and fair disclosure, and the commission has deemed in its ultimate wisdom that it needs to regulate that area. But there are areas where public policy would not be served by using the rest of the resources of the government to monitor it so closely. And that's where we have one of the exemptions under the Securities Act that enables us to do private offerings. Okay, so then you have pooled investment vehicles. So in 1940, you had the Investment Company Act of 1940. That governs the issuance of securities by pooled investment vehicles. And because you usually have managers managing those funds, you have the Investment Advisors Act of 1940. And that's the act that governs how investment advisors need to relate to both the investments that they make on behalf of the investors and also to the fund as its client. Now, there also the presumption is anytime you have an investment fund, it needs to be registered. However, you also have that public policy side that says, wait, we have people here who either have sufficient resources that we don't need to worry about them if they lose their investment, or they're sophisticated enough, or they're professionals, or they're a pension fund, whatever it is, they're institutional. So on that side, then you have that other little carve out for private funds. And that is the space in which we specialize. So on the, and of that, cryptocurrency funds are an emerging subset of that. So it really is the same as a private fund in many respects. However, due to the nature of what the investments are and some emerging issues, there are some slight differences, and that's what Mr. Laura will address a little bit later on. Now, on top of those laws, that's just the federal laws. We also have a set of, every state has what is known as the blue sky laws for someone who wanted to sell you the blue sky if you wanted to if I had a bridge to sell. So the blue sky laws are what the states have. They largely parallel the federal laws, but not always. Now, the important thing to remember is that a lot of people think, okay, I am outside that publicly offered space, and therefore I can do what I want. I can say what I want, I can talk to whomever I want, I can advertise however I want, but in fact, it is much trickier to navigate the space where you're not regulated than the space where you're regulated. Where you're regulated, there are defined rules and practices that say exactly what you need to do. When you're outside that space, it's an evolving area, and you really need to know where your borders are, because the regulators and the powers that be are quick to say, you crossed that line. And it's important to know also that notwithstanding the fact that you may be exempt from registration provisions, what are called the anti-fraud provisions of all of these securities rules always apply no matter what. So what you say matters, how you say it matters, and that's one of the ways that we help our clients make sure that with respect to compliance, with respect to the fact that when you have a private fund, you can't advertise publicly, and you may think you know what advertising is, but basically any statement you make in a form that can be deemed public, all of a sudden you're in that regulated space where you have to be very, very careful what you say. Knowing that overview and where we fit and where we focus our energies as attorneys gives you an idea of where this conversation is in today. And just to let you know also, so today is first in a series of workshops relating to cryptocurrency funds. You can get up quicker on the chair. I'm going to ask you to hand me that. Thank you. So today is, we're going to talk specifically about launching a cryptocurrency fund. How will you know when you're ready to do that? What stage do you need to be at to know that you can, that you are ready to go forward? and who can invest in the fund and those issues. In the subsequent months, we're going to have 6 more series. The second on March 15th will be on the capital raising strategies, what you need to know in order to develop entity structures. The following session in April will deal with tax and entity structures, which you need to know for the next step, which are the investment terms. So in May, we're going to discuss investment terms, and you need to know those for your disclosure documents. And so in June, we're going to have a session on the documents and filings. And in September, service providers, and session 7 in October will be ongoing compliance. Now, that doesn't mean that you have to wait until all of those sessions are over to ask your questions and to understand what happens in those contexts. A lot of this material is available on our website, and you have something specific that you feel that you can't find the answer to, then you're always able to contact us. So I would like to introduce our first speaker, our guest speaker, who is not with our firm, but is a blockchain executive who has been in this space for an unusually long time, considering how young it is. Peter Kirby, who is to my left, is a blockchain executive and longtime entrepreneur. He co-founded Factom and launched a successful token sale in 2015 with a market cap of 500+ million. Peter has also founded a blockchain hardware manufacturer, a neurochemistry product company, and a real estate development firm. He has a degree in biochemistry from Lehigh University and an MBA in entrepreneurship from the Acton School of Business. Peter practices laughter yoga and hosts elaborate dinner parties.
Thank you for the introduction. So the moral of the story is you need to find a really, really good attorney. Everybody know that? Okay. So I'm going to give a little bit of context of what's going on in the marketplace right now. As Beth Ann mentioned, I got in very early. I got obsessed with Bitcoin in 2012. I bought my first one at about $20. I wish I bought a lot more. And very early on ran a hardware company. We made ASIC miners, one of the very, very early ones in that space. In 2014, I launched a company called Factom. Maybe some of you have heard of it. We did a token sale in 2015. So this was very, very early days. Sort of the initial wave of blockchain companies that weren't just about sending money to other people in each other's basements. And what's been absolutely amazing is when we were talking about it in 2014, we were talking about, hey, there's this magical thing called a Bitcoin you've heard of, but it's not about the Bitcoin, it's about the blockchain. The underlying technology matters. And I would, say this in front of a room full of distinguished people like yourselves, and they would look at me totally blank. What on earth are you talking about? What is this nonsense? And, here we are in a world where it was on the front page of The Economist. It was, it's on every CNN news feed what the price of Bitcoin is. We live in a world where everybody has probably played in this market or wants to play in this market. Absolutely incredible. What an opportunity. We also live in a market where, given what day of the week it is, the capitalization of the blockchain space is $400 or $500 billion. This time last year, it was about $30 billion. So to say that some people made some money along the way is a massive understatement. Now, also look around the room and you have a sense of the number of people who want to get into this space in one way or another. So what's interesting is along the way, we invented a funding vehicle that's a very unique funding vehicle. And I'm not going to give advice about what to invest in or whatever else, but I'm going to give you a little bit of the sense of what's going on in the market right now. So the amazing thing about these tokens is that they monetize network effect. Everybody here has heard of Ethereum. In fact, most people probably have Ethereum right now. Ethereum is worth $70 to $100 billion, but it's not a company. There's no revenue. There's no real CEO of Ethereum. It is the network value, and the tokens, the tokens represent the market value of the network. Metcalfe said long ago that a network is the value of the square of the number of nodes, right? Facebook is incredibly valuable, not because of the revenue stream from ads, but because of the number of the 2 billion people that are on the network. The thing that we always struggled with in building networks was there was no way to monetize it, right? Zuckerberg got very, very, very rich on Facebook, but the rest of us didn't, right? And if all those people at Harvard who told all their friends at BU, who told all their friends at Stanford, all got a little piece of that Facebook network, it would look like a very, very different distribution. That's what happened at Ethereum. And that's what happened at Stellar, and that's what happened at Ripple, and that's what happened in a lot of these other early companies where the tokens represented the total value of the network, and as the network became more valuable, so did the tokens. So really interesting fundraising mechanism. What happened in 2017, and probably a lot of you participated or played in this space a little bit, is the idea of an ICO really took off. You had major players like Fred Wilson at Union Square, Mark Andreessen, Tim Draper start participating in these at the venture capital level. You also had giant hedge funds like Fortress start playing in the space. And suddenly it went from a bunch of people trading coins in their basement to billions and billions and billions of dollars of investment. So now here we are in 2018. Probably the hottest of the ICOs right now is the Telegram ICO. Sequoia, Kleiner Perkins, Benchmark, some of the most respected names in the entire venture community are participating in these things. What happened? How did we go from nobody's ever heard of it to, oh my God, this is the hottest thing in the world in just, what feels like 12 months? So it's interesting to study, and it's interesting to sort of dig into the how. But we don't have a ton of time here, so I'm going to talk real quick about what the mechanisms that people are using, and just so you know what you're going to come across. The original thinking when we were doing it in 2015 is there were two different kinds of coins. There was a utility coin, which is like an Ethereum. It runs the network. And there's a security coin. There are very few issued, but let's say blockchain capital is one of them. So for a long time, utility coins was sort of how we did it. People would sell these ERC20 tokens, and they would eventually become the network over time. The really important decisions that got made late last fall was utility tokens are really sort of uncomfortable for the SEC. And obviously the lawyers here can speak way, way more intelligently than I can. But what that's made is an instrument called a SAFT note, sort of the de rigueur way that people are doing these. And what a SAFT note is a modified Y Combinator safe note. Safe note stands for a simple agreement for equity. And they shifted it to be a simple agreement for tokens. And to Beth Ann's point, it's a way for accredited investors to register a security and then eventually convert it to a token when that network is ready. So that's sort of the modern 2018 variety of what you'll probably see out there in the marketplace. Obviously, your fund can buy live tokens. I'm certainly not going to advise you on which ones will go up and down. They will all go up and they will all go down tomorrow. I guarantee it. But what's happening in that market for SAFT notes is it's a hustle. So there are people who bought Telegram at 30 cents, and they sold it to a bunch of people who bought it at 50 cents, and they sold it to a bunch of people who bought it at 80 cents, and then it'll be around at $1. It'll be around at $1.50, and then they'll finally release it to the public at $2, $3. So that allows the insiders, the early people, to get in very low and sell to people sort of along the food chain. It turns out that that's how VCs make their money in stocks also. The thing that's very interesting about this is how quickly it happens, right? So the first Telegram notes were done late last year, and they'll probably be live. I don't know exactly what it is, but coming up probably within this quarter. So, over the course of 3 or 4 months, you get an instrument that is totally liquid and has already been trading at market values. It was already trading at market values that could be 3 or 4 times what the initial investors got in at. So very, very interesting stuff. Certainly not advice to do that or not, but it's just, you will see this out in the world, and being a fiduciary of other people's money, you just need to know kind of what you're getting into and what's going on there. So I'm going to go ahead and pass this to John, who can elaborate more on the infrastructure and the legal structure around this. But we'll be around afterwards, so there's an opportunity to ask a few extra questions.
Successful cryptocurrency investor. She is the co-founder and president of the Harvard Blockchain Group, the first blockchain organization at Harvard University, where she is an undergraduate student. Bushra oversees the activities and structuring of committees for over 300 students who have joined the organization. Bushra co-founded the National Muslim Women's Summit in collaboration with the Harvard Kennedy School, and they put on an annual conference which is fully funded and endorsed by several organizations and invites young leaders to embark on a year-long leadership fellowship targeting their communities. Bushra has been active in politics as an advisory council member to Texas State Representative Ed Thompson and Congressman Pete Olson. She was featured in a London-based radio podcast to discuss her story regarding the immigration ban and the election. She was asked by Times Higher Education to write her story regarding the immigration ban and the election. And on the link on our website to this presentation, you can find a copy of that article.
Awesome. Thank you for the introduction, and thank you for inviting me here. As they said, my name is Bushra Hamid, and I'm a student at Harvard University. And I'm here a little to talk about a student's perspective in the cryptocurrency space and how to get involved. I guess to begin a little bit about how I started getting in the space. I was studying economics in my freshman year in a Harvard basement, studying for like 6 hours. And then my friend's like, let's take a break. I'll teach you how to trade. I was like, I already trade stocks. And he's like, no, this is different. And ever since then, I got hooked and I began trading major currencies, and I saw the huge economic upside. And then I realized that a lot of people don't know how to get involved, but want to. And a lot of people would come up to us and ask us. There was a lot of interest, but not a lot of resources available at Harvard. So that's where me and a couple co-founders began Harvard Undergraduate Blockchain Group, the first blockchain group at the college level at Harvard to educate people and get them involved in the space. And we split into 3 committees because we sent out an initial email and we had about 300 people who were interested just from one email and wanted to get involved. And we were like, okay, this is more than we thought. So we eventually interviewed people, got 16 officers, and divided our club into 3 committees: investment committee, development committee, and the technology committee. And what's very different about us is that we're a fintech club at Harvard. There's not that many. There's a lot of finance and a lot of technology, but there's not one with an intersection of both. For instance, I study psychology and government, and I found my place at this club. And not a lot of people can do that at other organizations. We want everyone from different backgrounds to get involved and have a space, have a potential to get involved and whatnot. So it's a little team that they're going to see on the slide. And if you want more information, just go to hubg.io. Feel free to contact me or any of our other officers on there. But thank you so much.
Thank you.
Our next speaker is our managing partner, John Lord. And John has spent his legal career focused on advising emerging fund managers and has answered investment fund legal questions from over 1,000 emerging investment fund managers in nearly every state in the US and also throughout the world. He is responsible for forming more cryptocurrency funds than nearly any attorney. Mr. Lord advises investment fund sponsors on all aspects of their businesses, from capital raising and fund formation to implementation of their business models. His representation of a broad range of asset managers allows him to keep current with emerging trends. And prior to founding this firm, he practiced corporate and securities laws at a number of law firms, including in the private securities practice group, resident in New York City and Moscow offices of Aiken Gump, Strauss, Hauer, and Feld, one of the largest international law firms in the world. John.
One of the questions that I answer over and over, and there's really not a workaround for it, is how do I raise capital from people who are not accredited? And the answer is you don't. Yes, technically under Regulation D, Rule 506, certain funds would be able to raise capital from up to 35 non-accredited investors. The reality, though, is because even one unaccredited investor will raise your liability to a place that's really not acceptable, we would not recommend, and in fact, our firm's policy is that we do not represent clients that have even one non-accredited investor. So if you're less than 150 million, then we're going to look at the state regulation. If you're over 150 million, you're automatically with the SEC, you automatically have to have your investors be qualified clients. Again, this is assuming regulation by the SEC. Now, most of you in this room are not looking at that level as an emerging manager. So we look to the state, and this is important, it's not the state where your investors are located, it's the state in which you are located. So as the fund manager or the fund management team, you will be subject to the State Investment Advisors Act of the state in which you and your fellow managers are physically providing services. So the good news is if you're in the East Coast, chances are you are in one of the best jurisdictions to raise capital as a fund manager. We have divided the states into three categories, and this is just a capital fund law terminology, but there are the traditional Eastern states. The traditional Eastern states are the most fund-friendly states, and those include New York, Connecticut, New Jersey, going down Pennsylvania, Washington, D.C., even down to Georgia, Florida. These are the most fund-friendly states. Massachusetts is not one of these states anymore. Massachusetts has actually gone the other direction a little bit. So what I mean by the most fund-friendly states is even when the SEC passes a regulation that deems all cryptocurrencies as securities, there will be no change in your investment advisor, your investor's wealth standard. Next group of states, which is the intermediate states, post-Dodd-Frank states, California, Texas, Massachusetts fits here as well. There are also a few states popping up in the Midwest. And what this says is, yes, you have to have qualified clients. So if you live in California, once the SEC deems cryptocurrency, all cryptocurrency, to be securities, every one of your investors will have to be qualified clients, 2.1 million. However, there is not a requirement at this point to register as an investment advisor, to take the Series 65 examination, and to become a full registered investment advisor. And so it's an intermediate, we call them post-Dodd-Frank states. And then finally, we have the least fund-friendly states, and those are the traditional Western states. The state of Washington, Nevada, Colorado, Arizona, Utah, these and other states such as Maine, getting down into the South, most of the states there are going to require full investment advisor registration. And then no matter if all of your clients are in New York or California, they will all have to be qualified clients, and you will have to go through the entire process of investment advisor registration. That said, it's not that difficult. We represent a large number of state-registered investment advisors, as well as SEC-registered investment advisors, and it's not a excessively onerous issue. But keep in mind that if you're in those states, there's some additional requirements. So if you will be investing using leverage or using any form of derivatives, including futures trading, and we'd have to talk to specifically nail down what I mean by these. But if you're going to be involved in derivatives or leverage, and that can include margin, then you will be governed by the CFTC and will be required to have full commodity pool operator and commodity trading advisor registration and register with the Managed Futures Association. And at that point, you would want to have only QEPs, qualified eligible persons.
We know that the clients need to be qualified. Is registering as an investment advisor, is there anything that the manager needs to do to become qualified?
This really goes back to where you live. So if you are in one of these states, such as Washington, et cetera, you're going to need to take the Series 65 to qualify. And one thing I didn't mention is, in order to become a commodity pool operator or in order to become a commodity trading advisor, you'd need to pass the Series 3 exam, get registered as an associated person. Many of my clients, they'll ask, should I use leverage now or should I hold off? And I think in many cases, it makes sense to give yourself the broadest funnel you can when you're early on in your fund, and that would be to avoid CFTC registration, avoid that $2.1 million net worth in order to get some traction.
Thanks for putting it on tonight, guys. Really informative. I guess my first question would be kind of a strong question, but what type of things do you provide for a fund outside? I mean, what is stopping us from just going to LegalZoom essentially and putting together the structure ourselves and then filing with the SEC on our own? What is your value add, I guess, in the event, especially in a market like this where things are going to change rapidly and fast? Is there a certain value add that you guys have that would persuade us to work with you instead of just doing it on our own?
Okay, that's a question I guess I don't get too often. I would say, given the level of liability you're looking at personally, given the requirements you're going to have from your sophisticated investors who are expecting to see law firms, and it's not just the law firm. You've got, in order to start a fund, you need to have a law firm that is known in the space. We see the same names over and over. You need a fund administrator that's known in the space, and you need an auditor. And they all come together, and a sophisticated investor would not want to look at a fund that is not represented by a group that has that. So the question of doing it yourself, I'd put that out of your mind. The question of whether we're the right fit is certainly, there are a lot of great providers and options, but whatever you do, this is an area where you have to really look at potential liability. And one thing I think that we have to be very careful about is we get a pretty large volume of inquiries because of the volume that we're doing. And those come from a variety of sources, and we would only be able to represent really a small portion of them just because of some of these sophistication issues. It represents a very high liability for us. One of the things our firm is known for is, with over 200 funds formed, we've yet to have a single client even be sued. And that's really important for us to.
I feel like that deserves a round of applause.
Oh. Yes.
Yeah, I know this week we had a decision out of the legislature of Wyoming, and I know a lot of people that are involved in Bitcoin as well as ICOs really excited about it. Could you elaborate a little bit more about the Wyoming legislature, what they just passed, and how that's anticipated to sort of move the ball forward in terms of legal cases in favor of advancing the cryptocurrency market?
Yeah, I was excited to see that. In addition to Wyoming, there have been various locations throughout the world in some very unlikely places. Eastern Europe, Belarus has become a location. What these states and jurisdictions are doing is they're trying to develop a jurisdictionally friendly location, really more for the ICOs themselves. A lot of the pending litigation that you're going to see, a lot of the pending legislation, regulation, it's going to talk about the issuers. Now, we do not represent issuers and ICOs. We're focused on the funds that invest into jurisdictionally friendly location, really more for the ICOs themselves. A lot of the pending litigation that you're going to see, a lot of the pending legislation, regulation, it's going to talk about the issuers. Now, we do not represent issuers and ICOs. We're focused on the funds that invest into them. So there's an indirect way that's going to move things forward in advance. But from the perspective of where you should be located, I would not recommend any fund to move to their jurisdiction unless you're willing to pick up and literally move there physically, because these type of regulations are really more impactful on the underlying coin issuers than they are the investors.
Especially in a market like this where things are going to change rapidly and fast. Is there a certain value add that you guys have that would persuade us to work with you instead of just doing it on our own?
Okay, that's a question I guess I don't get too often, but I'm glad you're asking it for the benefit of anyone else that might ask that question. You know, I don't think there's even a solid.
There's not a button
alternative
on LegalZoom that says hedge fund.
Yeah, I would say, given the level of liability you're looking at personally, given the requirements you're going to have from your sophisticated investors who are expecting to see law firms, and it's not just the law firm. You've got, in order to start a fund, you need to have a law firm that is known in the space. We see the same names over and over. You need a fund administrator that's known in the space, and you need an auditor. And they all come together, and a sophisticated investor would not want to look at a fund that is not represented by a group that has that. So the question of doing it yourself, I'd put that out of your mind. The question of whether we're the right fit is certainly, there are a lot of great providers and options, but whatever you do, this is an area where you have to really look at potential liability. And one thing I think that we have to be very careful about is we get a pretty large volume of inquiries because of the volume that we're doing. And those come from a variety of sources, and we would only be able to represent really a small portion of them just because of some of these sophistication issues. It represents a very high liability for us. One of the things our firm is known for is, with over 200 funds formed, we've yet to have a single client even be sued. And that's really important for us to
I feel like that deserves a round of applause.
Oh, yes.
Yeah, I know this week we had a decision out of the legislature of Wyoming, and I know a lot of people that are involved in Bitcoin as well as ICOs really excited about it. Could you elaborate a little bit more about the Wyoming legislature, what they just passed, and how that's anticipated to sort of move the ball forward in terms of legal cases in favor of advancing the cryptocurrency market?
Yeah, I was excited to see that. In addition to Wyoming, there have been various locations throughout the world in some very unlikely places. Eastern Europe, Belarus has become a location. What these states and jurisdictions are doing is they're trying to develop a jurisdictionally friendly location, really more for the ICOs themselves. A lot of the pending litigation that you're going to see, a lot of the pending legislation, regulation, it's going to talk about the issuers. Now, we do not represent issuers and ICOs. We're focused on the funds that invest into them. So there's an indirect way that's going to move things forward in advance. But from the perspective of where you should be located, I would not recommend any fund to move to their jurisdiction unless you're willing to pick up and literally move there physically, because these type of regulations are really more impactful on the underlying coin issuers than they are the investors.
Just a quick follow-up question on that. I know that about most of the top 20 ICOs last year blocked New York City. Does that have an effect on the ability for people who have a fund in New York City to invest in it?
Yeah, and so a good thing to note is when you are investing in the underlying cryptocurrencies, it's really important to do your research as to where you're permitted to invest from. We will always form our local funds in Delaware. That is the location where you're going to focus. And this is really the first of many different areas that we'd go into, but keep in mind, we're talking about 3 entities. You've got your fund management company. Your management company is the one that would be regulated by the state investment advisor. That one would be in, for example, New York. Then you've got your general partner. And there's some issues that just came out dealing with tax that are really going to impact emerging managers. And we're actually doing an entire presentation webinar in April dedicated to that topic. We had comments from Mnuchin coming back a couple of weeks ago that really caused some concern there. But going back to the location of the fund, Delaware is the operative location for a domestic fund. For an offshore fund, you have either the Cayman Islands or the BVI. And the BVI, for example, has, there are many places that don't allow, there are many ICOs and other cryptocurrencies that don't allow investments from the BVI. And so a recommendation that we've been following is to set up special purpose vehicle Cayman funds. And so New York fund, I would not ever expect to see a New York fund as the investment vehicle.
I'm going to do a quick one from the web.
Oh, okay.
Prospective investors are not domestic. Would you suggest setting up directly as a master feeder?
Yeah, and again, these get into questions that are going to be covered in our structuring component. I can quickly address this, that one of the factors that we should look at is whether you expect to have offshore investors or US tax exempt investors, but only to the extent that you're going to use leverage, because that when you use leverage and you have a tax exempt investor, including IRAs, that would trigger UBTI. And so, yes, offshore investment vehicles should be set up when you have potential offshore investors, but this raises your minimum. You really should not be starting a fund offshore if you don't have a higher level of potential investments. Certainly, we wouldn't want to see a fund starting off with $1 million, setting up an offshore fund, because, and this is an important thing to note, your costs, your costs of forming a fund, and that includes your legal, your ongoing audit, fund administration, that all count against your track record performance. Even for most of our managers, they have the capital to pay us. That's not the problem, but we want to make sure that they have enough assets under management spread out so that their performance isn't dragged down. And so keep that in mind. Yes, master feeder is an option. We probably do about, for our funds in general, about a third, closer to a half that are offshore and domestic. But on the crypto side, with these smaller funds, we're seeing a lot more domestic than offshore for our smaller funds.
Gotcha. First off, thank you guys for coming out and having this event for us. As far as my question, for a crypto-based fund, I want to have access to some of the foreign exchanges. For instance, Binance, which is a Chinese-based one. It's one of the largest ones in terms of liquidity and coins offered. Right now, they don't currently have the option to create an institutional or corporate account. So how does a crypto fund go about having access to trade on one of those exchanges?
Yeah, that's a good question. And on each of the major exchanges, Bittrex, Binance, Gemini, Coinbase, GX, there are various issues that come into play there. As legal counsel, we usually indirectly discuss issues of how to set them up in the area of where there are various exchanges and where they're allowed. Often we're setting up in the Cayman Islands because Cayman tends to be one of the most universally accepted locations. Now, for specific nuts and bolts questions there, we often will refer to our fund administrators, because on the fund administrator level, and we work with a solid base of very good fund administrators, several of which are here today. And they would be able to answer some of those specific questions on where they're located. Same issue comes up with banking. There are about 5 to 7 banks that we regularly recommend. This used to be a bigger problem. It seems like it's getting better and better, where there's a good funnel of banking operations. But unfortunately, on the Bittrex, I don't know the exact. I don't have off the top of my head for domestic what the exact answer is to that. But really, your jurisdictions that we can do to make it cost effective, you're really looking at Delaware, Cayman, and BVI, and beyond that, it gets pretty expensive.
Hold it close to your mouth.
First, I would like to say thank you to the panel. Secondly, after you set up a crypto fund, let's say you're interested in another type of asset, maybe a stock or an investment, are you able to utilize the same fund to invest in, said asset, stock, or commodity?
Yeah, that's a great question. And so your ability to invest in a particular asset depends entirely on the scope of your offering documents. Now, there was a time, pre-2008, that fund managers would have extremely broad offering documents that would allow them the ability to take advantage of market opportunities because of the strength of their own portfolio. This is still the case for some very large fund managers, but a trend has quickly evolved towards a concept of a family of funds. And with a family of funds, your first fund, investors more and more want to have the levers in their own control to be able to say that they only want to invest in a particular asset or strategy. Now, we will have standard language that would allow an inadvertent or a, let's say, a strategic investment where you're looking at doing hedging, for example. There's no problem with having a strategy where you're using crypto and you're using equities, and it certainly would recommend using whatever instruments will best provide you with the needed strategy. But be very, very careful about investment scope creep, where you come across an opportunity and instead of forming a new fund, you just roll it in. And our laundry list of potential investment opportunities in your fund, in the offering documents, they're expected to be a backup for incidental. That's not expected that you're going to take that as a new strategy. One of the reasons that we are so insistent that our clients not just establish a single management company that's combined with a general partner and divide those. We want to see a separate general partner and management company is we need to have the ability to form a second fund. So as you see a new opportunity, you should be then forming a separate fund. And if you had those combined, then you would lose the advantage of your track record. So by having a separate GP, it silos the risk of Fund 1. So you have GP 1 and Fund 1, GP 2 and Fund 2, and then you have this umbrella management company that will manage all of your assets. So short answer is absolutely, just form another fund to take care of that.
All right, we got some questions from our online viewers. Thanks for joining us remotely. Straightforward question from Robert. He wants to know, is it possible to do a Regulation A+ offering to establish a fund? No. Not.
It's a hard
no. Yeah, I can explain the reasons maybe really quickly. So right now, technically, are cryptocurrency funds considered securities? We're going to say that eventually, yes, they will be. Well, the only two exemptions under the Investment Company Act that would apply here is 3C1 and 3C7, which are both not allowed under A+. And there are many other reasons why that would be a hard no. It's just very risky. The issue, A+ is intended to go after non-accredited investors. And I want to proclaim this with the strongest voice I can, that non-accredited investors, no matter how you get them in, this is just not the platform for it. So cast it out of your mind. There's so much risk involved in bringing in non-accredited investors to this.
In the beginning of the fund, if you decide to put aside an incentive pool of a certain percentage of ownership of that fund, would you be able to, that way to kind of while you're raising capital along the way to set aside that percentage once capital is raised and introduced from someone else to kind of give away without so much risking giving someone the equity percentage in the beginning and hoping he does a good job?
No, that's not the issue. It's not an issue of how much equity is reserved. It's the issue that you cannot pay transaction-based compensation, which means any form of commission-based or contingency-based fee. The key is, no matter how you look at it, a creative plaintiff or an SEC litigator is going to say, Okay, you have two people. One of them brought in $1 and the other one brought in 100 million. Why are you paying them different? And the answer is you can't. And so there is no, I will say reservedly, there might be some potential workaround, but we wouldn't want to come anywhere close to it.
Can you have a vesting schedule for the equity piece?
Okay, so the vesting schedule can come into play. The key is that if you're growing over time, and that's a great question, by the way, because if you're growing over time and you're giving equity and the person is involved with more than capital raising, then sure, you wouldn't need to necessarily give equity from the beginning. Be really careful. I would be hesitant when I talk about vesting schedule. I'd prefer to do that in a very specific context where we talk about all the potential issues that can come up with that. A vesting schedule can either be deemed a fee to a finder, or it can properly be used to incentivize a manager where part of their role is raising capital.
For emerging managers, I know like in the typical hedge fund space, the fee structure is like 2 and 20 for assets and performance fees. But for someone new to this as an emerging manager with say like $1 million in our management, what would you recommend as like a fee structure to start with? Would you recommend having an asset management fee at all? Or would you, is it just like on a case by case basis depending on the strategy?
Thanks for that question. That's a great question. So as most of you likely know, on the management fee side of a typical hedge fund, that 2% management fee has had some significant downward pressure. However, not in the cryptocurrency space. That's an area where the 2% holds pretty true. The other factor to consider is that 2% of your 1 million, that's all you get. So you've got your fees and your costs covered. They're borne by the fund, but on top of that, any compensation to the manager is in the form of that 2% management fee. And so I wouldn't say that bringing it down is necessary. Now, one thing that you may want to consider is entering into side letters with certain early investors or strategic investors where you have a sunset provision on your management fee that you either waive or reduce the management fee for a specific period of time, but you need to not sell yourself short, because documents that have very investor-friendly documentation paired with a small investment amount can look like an unsophisticated fund. And so you can get there through side letters. Same applies with initial, with minimum capital contributions. With a typical fund, a typical hedge fund, asset management fund, $250,000 to $500,000 is a pretty typical minimum capital contribution. Well, with cryptocurrencies, you have people, investors with very, very high net worths that are only putting in $100,000 to dip their toe in the water. And so we're seeing a lot lower minimum investment amounts. Certainly would never go under 50, but you don't want to put on your documents a number like 50,000, because that is immediately going to peg you as a less sophisticated fund. Now, over time, we see that those fund managers will raise the amount. So you cover that in side letters, but we wouldn't expect to see less than 50,000 as the stated offering amount.
We have time for maybe 2 more questions.
Yes, quick question. In regards to, this kind of refers to taxes and gain on the fund. Imagine if you have a foreign investor, accredited investor, who is investing from overseas into crypto, who is accredited investor. what is can you elaborate a little bit on the tax or gain structure a little bit?
Yeah, that's a good question. And this goes into the offshore component, which we're going to cover in subsequent forum. But when you have an offshore investor, they will technically not be subject to the accredited investor standard. However, we recommend that you all the same require accredited investors just because of your own legal protection. And the documents would require them to be accredited. But technically speaking, an offshore investor is by definition qualified as an accredited investor. But with offshore investments, it's very important to follow the local country's rules. And if the way that an offshore offering works, you're looking at many different jurisdictions, and you're going to have legal counsel looking at those investments. And if you establish accredited investor, you're going to meet the majority of these countries' rules. If you stray back from that, yes, you may be exempt on your end, but you could easily trigger something on the offshore side. Okay, and one last thing, on March 15th, we'll be doing this again. And so I would love to have you tune in and look forward to discussing that. And all the questions that were asked, we had many questions. We're going to compile them into a frequently asked questions webpage that will be available. We'll also be doing some short video clips based on those frequently asked questions. So keep them coming, and we will look to answer them as we can.
And that includes all the questions that were online for the people who are online and we didn't get a chance to get to. So everything will be answered in that FAQ.
Thank you.